Hi everyone, Gary Orff here. Well, the markets and the consumer both remain resilient. We continue to be somewhat surprised by the strength in the U.S. economy. U.S. domestic product grew over 3% in the second quarter of this year, and similar growth is expected in the third quarter, according to the Atlanta Fed estimates. Those are strong numbers. Strong consumer spending accounts for a good portion of that strength, as a slowdown that was expected in lower income household spending has been offset by continued spending in higher income households. A resilient consumer sector has led to better than expected corporate earnings so far this year. Perhaps the effects of broad-based tariffs that were announced earlier have not yet been felt, so an economic deceleration would not be all that surprising. And we look to future earnings expectations as a guide to potential cracks in that backdrop. Currently, there are few cracks for which we are concerned, but that is certainly subject to change. Labor markets appear to be weakening as measured by new job growth, and manufacturing is in contraction, while cost pressures are still a bit elevated. Continuation of these trends could moderate economic growth, which could give the Federal Reserve cause for further rate cuts as a preemptive step rather than a reactive one. Lower interest rates would be expected to lead to lower borrowing costs for companies and then enable them to invest in a business, hire workers, and spur growth. Stock and bond markets have acted favorably to recent interest rate cuts and to the prospect of more cuts to come. Fed funds futures are pricing in two more 25 basis point cuts later this year, and then a total of 100 basis points by the fall of next year. In the past, stock and bond prices have appreciated when interest rates fell. Could this time be different? Or is that expectation already partially priced in to current prices? Perhaps the answers to these questions are yes, and valuations indicate as much, but as investors, we remain optimistic going into next year. And the reason is the strength in both the economy and expected corporate earnings. There does seem to be a large amount of hype that surrounds artificial intelligence, a process technology that can improve productivity, but that also requires substantial investment to support. Investors have become enamored with the prospective profits to be generated from AI-related investments in infrastructure, but there's little proof at this point what those returns on investments could be. We remain believers in the AI revolution and want to have exposures to companies driving its growth, but we tend to temper our enthusiasm a bit when that is all anyone wants to talk about, as it seems to be currently. And regarding the federal government shutdown on October 1st, in the 6 prior government shutdowns that lasted longer than one day, the S&P 500's average 3-month performance from the start of the shutdown was about 6.6%, with gains coming 5 out of 6 of those times. Now, of course, past performance doesn't guarantee future results, and our concern might be elevated should that shutdown last into months rather than days or weeks. As always, we thank you for letting us work with you toward achieving your financial goals.